Welcome, ladies and gentlemen, to the London School of Economics. My name is Felda Hardymon. I am the MBA 1975 class professor of management practice at Harvard Business School, retired as of July. I'm so pleased with that. I'm also a general partner at Bessemer Venture Partners and also have been a visiting professor here. Before we start tonight, there's a few housekeeping notes I want to give. For those Twitter users in the audience, the hashtag for tonight's event is #LSEVC. But please put your phones on silent so you don't disrupt the speakers. Unless that's really your intent. This evening is being recorded and will be made available publicly through the LSE website, provided there's no technical difficulties. As usual, after the lecture and the panel, there's a chance for you to put your questions to the panelists. You actually have, courtesy of one of our sponsors, Columbia Lake Partners, a pad. So if you will write your questions down, the stewards will pick them up during the panel, and that way we can organize them. And later, if that doesn't work, we'll also take questions from the audience, but usually that works quite well. It is funny, by the way, that this is a technology-based group, and we're having you write on pieces of paper and passing them forward rather than like tweeting us the questions. I will introduce the panel when they come up, but let me introduce the way this evening is going to go is we're going to have a small quasi-academic talk, an accessibly academic talk about the question about venture capital in Europe. This is actually quite a really important question. And the reason it's an important question is if you think about the role of venture capital in the U.S. economy. So the U.S. economy is something like $18 trillion. In the U.S., 11% of all private sector jobs are in venture-backed companies. That's an astonishing number. What's more astonishing is 21% of the revenue in the GDP comes from venture-backed companies. Those are NVCA numbers. So the only job-creating machine in our economy that has been reliable over the last 40 years is venture capital dollars. And a thriving innovation economy financed by venture capitalists make a difference. So whether or not now's the time that Europe is actually going to emerge as an important center of venture capital and emerge as an important creator of jobs is quite critical, as you're going to see from Ulf's talk. So let me introduce Ulf. Ulf Axelson is the Abraj professor here at LSE. He is the founder of the Abraj private equity program. LSE actually gives a degree in finance and private equity. You would think that the next degree is going to be in finance and pole vaulting, but it is a real degree. In fact, in the audience tonight, would the students who are in that program raise their hand? Because there's a lot of venture firms in this audience. If you see someone raising their hand, give them a job. Give them a job. This has been a successful program going into its, just finishing its 5th year. A significant portion of the graduates have gone into private equity, venture capital, venture debt firms in Europe. And Ulf has been the founder of that. Also, Ulf is one of the star academics in private equity research. This is finance is an arcane field, so it's measured by prizes you win for papers. Ulf is one of 2 people who's ever won 3 prizes at the Journal of Finance for papers, and 2 of them were on private equity. So So how'd I do? He's also the rarest of all people. He's a Swede with a sense of humor.
All right. Thank you, Felda. I should also thank Felda for, he didn't mention this, but Felda actually helped me start this program 5 years ago and has been back every year, essentially, helping teach part of the program to the great benefit of the students. So thanks a lot for being such a big support, Felda, for us. So what I want to do as kind of the token academic of this talk, before I give over to the people who actually know how you do this business, is throw out a bunch of facts about the European venture market. Okay, so why am I interested in studying this? Well, as Felda kind of alluded to, I think even though this is kind of a small part of the economy, if you just look at how much is invested into venture capital, we know that financing innovative entrepreneurial firms is really important for the growth and the employment in the economy, not only because the firms grow up to employ a lot of people once they become the Facebooks, et cetera, of the world, but we also know that kind of the spillover effects on the rest of the economy in terms of the know-how created that helps other firms grow and be more efficient and helps consumers have a better experience. Innovative activity, R&D, is really key. It's actually for each dollar that the firm itself catches in profits, about 5 times more goes to other firms in terms of spillover. So it is a very important part of the economy. So what does it take to have a successful, innovative financing market? Well, I'm going to kind of slot it into 3 different parts. Right? So one is you need entrepreneurs. Okay? So you need people who have good ideas and dare to go out and follow those ideas and start companies and actually know how to grow these companies. You need a good entrepreneurial climate. You need financing for these businesses, right? And that's not an easy prospect because there's so much to sort through, right? So you need experts who know what is the loser idea and what is the winner idea. And once you finance something, you need to actually assist these entrepreneurs in growing their firms and monitoring them so that they do the right things. And that's where venture capital comes in. Right? So that is an important part to have in the ecosystem. And then the third part, in order for the venture capitalists to actually be willing to invest anything, they need to see some profits down the line, and you need exit opportunities to do that. Right? So you need to be able, in some time frame of 10 years, to grow these firms and take them IPO or be able to sell them to some other big company. Right? So these 3 components are essential for this community to prosper. So how does Europe look on those dimensions? Well, I would say the reputation is pretty bad. So basically, a lot of people claim that venture capital only really works in Silicon Valley. And here's a picture which basically shows, this is like the hotbed of venture capitalists. This is Sand Hill Road, and I guess these cars are supposed to represent companies that are going for the great exit to Sand Hill Road. I just pulled that as a random picture from a random article out of many that talks about how bad Europe is. So this article that I pulled says, what's wrong with European venture capital? So what is it that people think has been wrong with the European venture capital markets? Well, I would, again, categorize it into these 3 different parts of the environment. So one is that the entrepreneurial climate is supposedly worse. So there's not enough people that dare to go out and become entrepreneurs. And the ones that do end up never leaving their companies. So you don't have what you have in Silicon Valley, which is this repeat entrepreneurs who start one thing, they get experience, they start another thing, and the venture capitalists can kind of tap into that community, and that community kind of provides role models and provides experience, and that creates even more entrepreneurs. So there's been attacks on Europe on that ground. Some people claim there's a stigma of failure in Europe, which makes people more risk averse. That is, if you fail when you try to be an entrepreneur, somehow it's hard to get employment, it's hard to try something new, so therefore no one really dares. So that's the entrepreneurial side. People claim that venture capitalists are worse, in the sense that They haven't had the same type of experience. They're not as experts in actually spotting firms. Some people claim that the European venture firms are filled with more bank kind of finance-oriented people who don't have the entrepreneurial mindset, and they don't know how to kind of take risks and assist the entrepreneurs going forward. And then people claim that the exit markets in Europe are worse, so we have less of the stock market-oriented systems where you can go IPO, and there's like fewer of these huge firms like Google and Microsoft, etc., that are ready to snap up the startups once they become profitable. So what we set out to do, so when I say we, I did this with one of my PhD students, we set out to just look at some data to check first how much truth is there to this when you actually look at the data, and then is there any hope for Europe going forward? And also I wanted to look at what of the type of variables when you dig into it is it that seems to drive kind of successful venture capitalism. So we pulled together, this is one of the biggest databases, the Dow Jones Venture Source. We have about 35,000 first-round deals where we know a lot about who were the entrepreneurs and their backgrounds and the venture capitalists and their backgrounds. 1/3 of them are in Europe, 2/3 of them are in the US, and we complement that with a bunch of other data to find returns and background data on entrepreneurs and venture capitalists. And then we're basically going to look at some very simple stuff like what is the likelihood that these firms actually manage to get a good exit at some point? So did they manage to go IPO? Did they manage to have a good trade sale, meaning being sold to Microsoft or something for big bucks? Okay. We also look at actual return data whenever we have that. And here is basically, let's see if this, here is the first cut of the data, which essentially shows that Europe really doesn't do very well. But this is just looking at historically what have been the fraction of venture-backed US and European deals that have led to either an IPO or a trade sale. And what you can see here is like a pretty grim picture for Europe, right? So the probability of an IPO is twice as high for European, US-backed venture deals than for European deals. And the probability of a trade sale is 8% higher in the US relative to Europe. So that doesn't look very good. Now, it turns out that this is quite a misleading picture, actually. Because if you actually just look at a simple thing, which is when were these deals actually done, that explains a lot of this difference, and it makes it look much better for Europe. And in particular, the whole difference when it comes to IPOs goes away. So there's no difference in probability of IPOs in Europe relative to the US. Why is that? Well, essentially, if you look at, so this is the deals we have in our database, okay? And when you look at the timing of this, so the red line is number of first-round deals done in the US backed by venture capital, and the blue line is the same for Europe, okay? What it turns out is kind of that Europe woke up at the wrong moment, okay? So most of the deals that got started were right before the dot-com bust, essentially, in 2000. And actually, a lot of the deals, so not much before that, and it turns out that it's before that the IPO probabilities were the highest. Then it's kind of gone down to around two-thirds to one-half of the deal activity in the US. And the fact that Europe got started there basically means Europe missed out on the good IPO markets in the 10, 15 years before that. Okay, so if you look at, so here what I've plotted is for each year, look at the deals that got financed in that particular year, and then check what fraction of those deals ended up having an IPO at some point in time. Okay, and the black line is Europe, and the blue line is the US. So what you can see from this graph are essentially two things. One is that once you just look at the particular year, there's really not much difference in the probability of an IPO between Europe and the US. Okay? The other thing is, as you can see, the probability of an IPO has kind of like gone down steadily throughout the year. Now, there are two reasons for that. One is it's simply the case that in the data that we look at, since these recent deals haven't had enough time to exit. You're not going to see the same type of IPO fractions, right? That explains part of this drift downwards. But the other is that actually, once you control for that, it turns out that it is just much less likely in the 10 years after the mid-90s, or actually after 1999, you are just much less likely in general to have an IPO. It's kind of like the IPO market's essentially shut, right? So there's been a bit of a ice age for IPO, if you will. But that explains all the difference in IPO probabilities between these two regions. If you look at, this is a hard graph to read, so I'll just tell you what is on it. If you look at how profitable the IPOs were in the two regions, it turns out that, and that's what I'm plotting here, the blue line is the profitability of US IPOs and the red line of European. It turns out there's also no statistical kind of difference in how profitable they were. So it turns out like the simple thing, time, explains every difference there is in IPO success and profitability. So that's IPOs. Let's go to trade sales, and that's a different story, actually. So it turns out that you do explain part of the difference in the lower probability of trade sales in Europe by just controlling for time, but the difference doesn't go away, okay? And it's basically, turns out that the difference is kind of like almost always the same. It's about, you have about 8% lower chance of a trade sale in Europe than in the US. It just seems like it's harder for these firms to find an industrial buyer for some reason. You also see here this drift downwards in the probability of a trade sale. That's purely because these deals haven't had enough time to exit. Actually, once you control for that, this kind of probability of doing a trade sale within the same amount of time doesn't change over time. So the trade sale market hasn't really died. It looks the same throughout the years. But Europe actually looks worse on this dimension. So it's in the trade sales that there's a difference, not in the IPOs. If you look at the profitability, this is for trade sales, so conditionally on having a trade sale, how much money did you get in those trade sales? There's a little bit of a difference also. It seems like the European trade sales are slightly less profitable than the American trade sales. So that's just a simple kind of time series of this stuff. Then we dealt a little bit further down to drill into what effect does the characteristics of the two partners who are involved in a VC deal have on the success probability of the deal. So that's the entrepreneur, the background of the entrepreneur, and the venture capitalist. Okay? So the first thing we looked at is how much does it matter whether you have an experienced entrepreneur when you do a deal relative to not having an experienced entrepreneur? It turns out that matters quite a lot, and there is a pretty big difference between Europe and the US when it comes to the experience of entrepreneurs. So this graph, what this graph shows you is essentially, again, grouped by the year that a certain deal was done. The blue line shows in the US what fraction of VC-backed deals were done with entrepreneurs that have previous experience starting a firm, so serial entrepreneurs, right? What you can see is that that's about 35%, so 1 out of every 3 deals uses a serial entrepreneur in the US, while in Europe, which is the red line, the same number is about 15%. So there is truth to this idea that there is just a smaller pool of kind of entrepreneurs you can go to with experience in Europe relative to the US. And that turns out to actually be quite an important predictor of success. Well, as it turns out, actually, it's not so much the experience that you have, it's not so much that you have experience, it's really what type of experience. So what I plot in this line is out of the entrepreneurs that were backed by VC and had founded some firm previously, what fraction of them in the US and Europe had actually done well in their previous venture? Okay, so what the red line shows you is that for the European deals that backed the serial entrepreneurs, 50% of them backed a guy who had failed in his previous venture, and 50% backed guys who had been successful in their previous venture. In the US, there's a smaller fraction of failed guys who get financing. And it turns out that the failed guys are not really that good, surprisingly. So this is going to drive a little bit of the difference in exit probabilities as well. Now you can see they kind of converge towards the end. So, and the end here is 2011. So now at that point in time, it's not looking that difference. Now one thing you can, if you want to say something positive about the Europe here, is that it really doesn't look like there's any of this stigma of failure, right? So if you have failed in a previous venture, you're no less likely to start a new venture and get financing than you are in the US. So the stigma of failure seems like a bit of a myth in Europe. So let's just look now at how that plays out, how those entrepreneurial background variables play out in predicting the success of a venture capital deal. And so this is kind of a statistical regression. I don't want you to completely try to decode all of this. I'll just tell you what it means. So essentially, what we're looking here is trying to predict the probability that a deal will go IPO or have a trade sale, that is, be a successful deal. It turns out that having founders with experience really helps to make sure that you have a successful exit going forward. But most of that turns out to be driven by the guys who have a successful experience. So they've started a firm before that actually did well. Okay? Now, once you look at only the set of serial entrepreneurs and you compare how does Europe do relative to the US, it turns out that Europe does as well also on the trade sales as the US does on serial entrepreneurs. Okay? So a lot of the difference in trade sales seems to be on the non-serial entrepreneurs, and the fact that there are just fewer serial entrepreneurs to pick from in Europe. It also turns out, as I show in this last regression here, that if you only look at the guys without experience, so the entrepreneurs that got backed by a venture capitalist, but they didn't have any experience starting a firm before, the European venture capitalists actually did worse on that set than US venture capitalists. I don't have a good explanation for this, but it seems like the European venture capitalists were not so good at sorting through these inexperienced guys in a way that the US venture capitalists did. So entrepreneurial background and the pool of serial entrepreneurs seems quite important for the success of the venture. Now I want to go to looking at some of the venture capital variables. So how much does the identity of the venture capital matter for whether you're going to have a successful exit or not? And here what I'm plotting is, for these two regions, the US and Europe, I'm plotting what's kind of the average experience in terms of, relatively speaking, how many deals have you been doing as a venture capitalist over time in these two regions. And what you can see is that the guys who do VC in Europe have just had quite a lot less experience, so they're kind of younger and less experienced, have done fewer deals. But it's starting to converge towards the end of the sample. And it turns out that the VC experience variable has a huge impact on whether you're going to have a successful deal or not. Why is that? We haven't quite dug into that. It could be because experienced VCs are better at selecting the good firms, or it could be that they're better at monitoring the good firms and working with them to grow them to the right size. But it has a big impact. And that's what I'm showing in this statistical regression, which basically says that VC experience is highly statistically significantly related to having a successful exit. Okay? And it helps if he sits on the board, not surprisingly. And it actually turns out that once you control for the experience of the VC, you explain any difference there is between success in Europe relative to the US. Okay? As a side kind of finding, we say it's actually the general experience seems to be more important at the firm VC level, while specialization into an industry is more important for the particular partner that sits on the board of the venture deal. Okay. So where does this leave us? Well, it basically says, we can explain any difference that is left after you control for time between Europe and the US by these entrepreneurial and venture experience data. There is something positive to be said for Europe in the sense that since VC experience is so important, since it seems to have converged towards the end of the sample, things should be looking better going forward. One thing that I want to note, though, is all I've told you so far is really looking at a sample where we have the detailed data for deals done between, in Europe, essentially mid-90s and 2011. And for most of the deals in Europe was actually 2000 to 2011. That turns out to be an unusually bad time to be a venture capitalist overall, right? So we haven't had time to or the history has not played out long enough to see what's happening with the deals done after 2011. But I want to leave you with some trends for that last period, because it seems like a lot of things are actually changing, and changing in the direction that seems positive for the European venture market. So let me leave you with a few of those snapshots. So here is just the amount of deal activity in Europe relative to the US. I've been nice to Europe here because I've indexed everything to be 100 in 2011. It's actually kind of like a bit below that. But what you can see is that European deal activity since the end of the sample I showed you has grown much quicker in Europe than it has in the US, up by like 80% relative to 16% in the US. So activity is growing. It's also the case that this period from 2001 to 2011, I told you there was little IPOs. In fact, since 2011, if you look at the really big exits, so these are the exits in Europe of so-called unicorns, meaning firms that are valued above $1 billion, okay? It turns out that this period from 2001 to 2011 had only a handful of those, but if you look 2012 to 2015, we've seen 2 times as many exits in those 4 years relative to the 10 years previous. So there's been a lot of good exits, and all of them have been in the last kind of 4 years. And there's more to come, because in the whole set of venture-backed European deals, these kind of red bars show the ones that have a valuation now that is over $1 billion, but they have yet to exit. And that's about 27, so it's about 4 times as many as the number of 1 billion exits in the 10 years that I was looking at before, 2001 to 2011. So what does that mean? Well, it means that we've had many more home runs and many more home runs to come in Europe in the last few years. And these home runs are really important, right? Because venture capital is a really skewed business that thrives off the big winners, right? So it's going to be good for returns. It's also good for strengthening kind of the entrepreneurial climate, because now you have role model firms that have been really successful, and that kind of encourages other people to become entrepreneurs. Plus, the people that work for these firms that have exited and have been really successful are going to provide a deeper pool, hopefully, of serial entrepreneurs, even in the lower ranks of those firms going forward. So couple that with a VC community that's getting more experienced, and also an ecosystem around venture capitalists that has grown to become much deeper than it was before 2011, and maybe things are looking up. So what is this ecosystem I'm talking about? Which is essentially all the stuff that makes venture capital actually able to function in the background. So lawyers, accountants, we have a much bigger network of those in Europe now than we used to have. Venture debt, turns out that about half of all the venture deals in Silicon Valley uses what's called venture debt. That is extra financing through a debt provider. Usually it's been Silicon Valley Bank, one big bank, which has been quite important to kind of extend the runway for these firms. Didn't exist in Europe before like 5 years ago, maybe. And that's something we're also seeing coming. So Silicon Valley Bank got a charter 4 years ago in Europe. And actually our sponsors, Columbia Lake, one of our sponsors, Columbia Lake Partners, is another player that does that type of activity. So Being an academic, I don't want to claim that everything is great because I haven't seen the results of this. But it does look like things are looking up. I'm going to leave it to the people who actually do the deals to delve more into the question of whether we think venture capital Europe has finally arrived. So I'm handing over to you, Felda.
So let me start. I've asked this to be a relatively informal discussion, and I'm just going to kick it off with Magnus. You're the guy who makes this all work. If you and your colleagues don't believe that maybe now is the time, then it won't be the time as far as having the adequate money. Do you believe it?
Well, I think the reason that Felda asked me to join this panel is he knew that I'd had experience in my limited partner capacity of facing the challenges in persuading investors to commit to European venture, although I've always been a strong believer in it. In my Hermes days, where I was running a European venture capital fund of funds, but as part of it was a global buyout private equity group. I remember my first investment committee getting some hard questioning and effectively making it look as though I was asking people to commit to a colonoscopy rather than to a specialist investment, and saying, where's this coming from? And one of the investment committee members saying, well, we all carry our venture capital scars, and another one saying, well, I've got more scars than flesh. And so there was resistance even with a specialist fund. And then, as Felda said, in the Rothschild investment world, we've been very, very long-standing investors in venture capital and private equity, and still are materially overweight relative to other asset classes and to other managers to venture capital, but very, very heavily US weighted. Now, what are the reasons for that? I think there are two principal reasons. One is that in the US, to take one extreme, and Israel, which has been another very successful venture capital environment, to take another extreme. In the US, you have a vast market from the day you start trading before you have to internationalize. In Israel, you have a market which is insufficient to create a scale business, and so you have to be a multinational from the first day you trade. In Europe, you're neither one or the other, and there's an additional layer of risk for companies who are looking to become multinationals and to scale to become billion-dollar exits. So that's a sort of macro additional layer of risk that people committing to European venture are being asked to take. The second reason is one of, when I first went into venture as a GP, I can remember being asked the question, this was in 2000 in all slides, of what do you get if you cross a lemming with a sheep? And the answer was a venture capitalist. And I think whoever said that hadn't met LPs, because LPs like to invest where they're investing alongside other institutions and where they are coming into a fund program where there's been a history of managers raising fund after fund. And that ecosystem is less well established in Europe than it is in the US. It's not because of lack of opportunity. As you saw in the slides earlier, there was a significant amount of capital raised in Europe in the sort of 98 to 2000 period. And those funds were not a universal success. The more scars than flesh came from that experience.
They were a disaster.
And that's what people are swimming against. LPs have long memories.
So why isn't it a disaster? Saul, why aren't you a disaster?
I would say, just in general, every single venture ecosystem, Israel, the Valley, and Europe included, have all had massive down cycles. I remember being in Israel 2010 to 12, and I think during 1 year in Israel, I think less than $50 million was raised by the entire venture capital industry, and that was all raised by Sequoia. So I think every ecosystem goes through cycles. I would say that we are in London and Europe today where the Valley was in the late 80s, i.e. we've had a few successes, but the best years are ahead of us. So I think the analysis that Ulf showed in terms of, the big build-up over the last 10 years of European exits, they've been coming to...
Why is that important? let's go a thing deeper here. Why is it important? Why are the successes so important? What does it create?
I think
Makes it really work.
the virtuous circle that Ulf was describing, successes, create role models, successes create confidence amongst investors and amongst LPs, successes, create employee number. I mean, how many Criteo employees made over $1 million? Probably 30, 50. Those are all people who are now investing in the ecosystem in Paris. The same is true of the people who are at Skype. If you look at the people who started Love Film, they went on to start Zoopla. They went on to start Graze. If you look at the people who started TransferWise, they were at Skype. So I think, we're early days in the evolution of this ecosystem. And I think, the smart LPs, like Horsley and others, have been investing in Europe for 15 years or more. I mean, the biggest lesson I learned at Index about investing is, you have to invest through cycles. And if you don't invest through cycles, you will always, have war stories. You will always say, oh my God, look how bad, those 2 or 3 years were. You have to take a long-term macro point of view. And I think the people who take a long-term view on venture, people who take a long-term view on the internet, people who take a long-term view on technology, you still have to pick the right managers, you still have to pick the right entrepreneurs, you still have to accept extraordinary rates of failure. But if you can't invest through cycles, you have no business being in this business. And I think, that has been one of the things that has been, a problem for European venture.
So Europe's just been in a bad, been in a startup phase. It's been a bad time. Now it's going to be the same. You've been both sides, right? So you've been in the world's hottest market. The way it is in Silicon Valley, by the way, is nobody sleeps because they're worried they're going to miss a deal. That's honestly true. Nobody sleeps. There's no social life, none whatsoever, because all you do is talk about, am I exaggerating?
You wake up every day reminded how bad you are at the job because 16 deals got announced that were unicorns while you were sleeping, if you chose to, yes.
So how is it different? I mean, you've done both sides.
Well, I'll tell you one thing that's different. The breadth of exits is starting to increase. The depth doesn't feel like it's here yet. When you look at scale of outcomes, the new word in the Valley is the decacorns. It's the multiples of the $10 billion outcomes that are
decacorns
that are running well. Thunder lizards, pick your bad analogy or example, but it takes a Facebook or a Baidu in China or an Uber in the private markets now to rattle industries. And when you see, entire collections of funds, hundreds or potentially thousands of entrepreneurs making life-changing economics off of some of these companies, that's the ripple effect that really creates an ecosystem. And I think that's one of the material things that's still been lacking from Europe, which is you don't yet have the scale to really send those shockwaves around the world. The reason why there are now dozens of active venture entities in China is because the market has created so much wealth and created so much opportunity that the lemmings and sheeps come in, and whether both on the entrepreneurial side and the capital side. And in Europe, I do agree that the best years are still ahead and that things are ramping up, but we haven't seen that yet. And the reason why Bessemer doesn't yet have an office here is because we haven't needed to yet. We've been able to support it remotely, and we've been able to, have a good cross-selection of deals. But frankly, it's sort of like maybe a combination of a Salt Lake City for B2B and a New York City for consumer, which is great.
Do you realize how obscure that analogy was in this room?
It was meant. It was meant to be provocative, intentionally.
It might be right on B2B. It's just outright wrong on B2C. I mean, there are much bigger consumer outcomes that have come out of London than New York.
Name them.
King, Skype, Zoopla, Rightmove, Just Eat is 3x, by the way, the size of Grubhub, and several others. I mean, I don't know of the large consumer outcome that has come out of New York.
Well, so the analogy I draw those, you'd take all of those combined, every private unicorn and exited unicorn, sum them up, and I don't think they total Uber's private market cap. They certainly don't reach.
No question.
Reach
But I think
Facebook's.
one of the questions for me is people talk about the U.S., but it's actually the Valley, and a little bit of Seattle with Microsoft and Amazon. But New York has really not produced that much. Boston, other than...
So are we talking about the wrong thing to be talking about Europe? Should we be talking about London and Berlin
I think so.
and
I
Stockholm?
mean, I think, the notion of... And I think, Magnus will have a deeper perspective on it, but I know the LPs that we talk to, and have spoken to for the last 10 years do not have, geographic allocations anymore. They are looking to get top quartile, top decile returns globally. Now, that means the US and it means China, and then it means cities or funds. I don't think it's...
Let me shed some... I think you're right. We actually did this analysis in the data we had because we could break it down by Silicon Valley versus other stuff, and it's all Silicon Valley, right? So the 50% rest in the US, it's worse than Europe. And the UK actually, so in Europe, it's UK is better than the rest. So the kind of the cities and the Silicon Valley seems to be driving it.
Is that the way you see it, Magnus, as an LP? I mean,
Yes, we do. I mean, we're very, very heavily weighted to not universally. We've just made a new investment with a Seattle manager, but to Silicon Valley in the US, and our European program has a strong overweight to London. But it's that whole, I mean, I absolutely agree with what Saul said about taking a long-term view, and that meaning you need to build manager relationships so you can be with them fund after fund after fund. And that's been harder to establish in Europe. There aren't that many venture managers who are managing Fund 5, Fund 6, Fund 7. I can just about get off the fingers of one hand, but only just, whereas in the Valley there's dozens.
So I ask, because even if you take a long-term view, if you just throw $1 every year at every venture capitalist that shows up in every part of the world, it turns out that you basically make less money than you do investing in the stock market. So the only times when venture really did better, significantly better than the stock market, was in the US in the 90s. So it's not all about long term. It must be that you have to go for the winners. I don't know how you think about sorting through the venture capitalists to find the right ones.
Well, it's even, I mean, what your message is, it's even more important to find the right manager in venture capital than it is in long-only investing or hedge fund investing or real estate investing. And that's why I go to my point of saying you need to build those relationships with groups who are going to be through more than one cycle, managers who you can have capital committed with. And that's what's harder to do in Europe at the moment than it is in the US.
Yeah, I mean, Felda's actually done the academic research on the correlation, but it's extremely high. I don't remember the data, but 16 of 20 firms that were top quartile in one period repeat in the next.
Yeah, no, that's called persistence. This is the only. You will see if you see an ad up for Fidelity and it says this mutual fund's performance doesn't guarantee the performance in the future. That's not true in venture capital. It is a persistent asset class. So since 2005, this study's been run many times. If you take, if your fund is in the top tercile of that vintage of fund, then the chances of your fund being in the top tercile, the next fund being in the top tercile, is about 50%. So if you think of a chart that has next fund, current fund by terciles, the big numbers are all in the middle. So that's persistence, and that's the reason why the success begets success. The rich get richer in this business, which makes what Saul did absolutely crazy. He left one of those funds to start up that ladder, which is a very hard ladder to go up.
No, but I think the data probably also shows the four disruptors, or whatever the numbers are, oftentimes come from people that have left strong platforms and reconfigured. And I think the positive pieces here, the reason why I'm here, the reason why I suspect Felda spent a lot of time, and the reason why I suspect you're going to see a lot more international venture capitalists here, is the earlier points that The trend lines are what's exciting. And for many of you that are young starting your careers, you don't want to be buying at the peak. You don't want to be entering into a market that's headed the other direction. The question is, how big can this become? And I absolutely believe, and I suspect most on the panel do as well, that the momentum is building here and that it's just a matter of time until that decacorn emerges from the venture-backed community here, and taking accelerators and creating that ecosystem and seed funds that will actually take risk on Series A deals and put some big swings out there to have the opportunity for those fantastic outcomes. That's what's missing. That's what it takes, and that's why it's awesome to see people that are, committing their careers early to dive into this field, because it will be a virtuous cycle.
I mean, if I can play the sort of the glass half full for a moment, because I know part of my role here is to be the cheerleader for European venture, but
you closed your fund, so what the hell?
I do think, there are a couple of very significant advantages that currently exist, particularly in the Valley, but in the US, that we're still missing in Europe and in the UK. One is knowledgeable institutional investors who've invested through cycles, both on the LP side and on the institutional investor side. So, we don't have significant liquidity in the public markets. If you're a late stage company and you're looking to IPO, unless you have a very UK-centric proposition like a Zoopla or a Rightmove, if you're an enterprise company like Mimecast, you're much more likely and you're much smarter to go to the US, where you've got an institutional investor community that understands you and will take a long-term view. So I think we are way behind the curve still.
Just to be clear, when you talk about institutional investors, you're talking about when you get beyond the step.
I'm talking both on the LP side and on the sort of Fidelity, T. Rowe sort of pre-IPO, post-IPO side.
As the crossover investors, right?
And it's emerging, but we're still very, very immature there.
Magnus, those, I was going to say,
I'm going to challenge that.
Yeah, I was going to say that those are not geo investors, right?
The two examples I was going to give of appetite for risk capital in the public markets in the UK are my old firm, where it's good to see two of my colleagues here today, IP Group, which has raised hundreds of millions. It raised £200 million last year on its balance sheet, and something like 300 for its portfolio, and Imperial Innovations, which has done equivalent. So there are,
they exist.
It's a more limited
and Neil Woodford and Peter Lansdowne have been backing most of them, but literally they're on one hand. Yeah. They're not on.
But I would also say the LPs are here. If you look in the private equity markets and say where do the CVCs, the KKRs, the big TPGs, the buyout groups, where do they go to raise money? They'll go to the Middle East, they'll go to Asia, but London is a big fundraising point. So there are no shortage of institutions who are happy to commit to an LP vehicle.
Venture.
But they're carrying those scars, and that's what we're battling with.
Fortunately, they're smart. There's a lot of US LPs who are investing.
Are most of your LPs US?
It's mixed. We have US LPs like Horsley. We have European LPs like LGT. We have an Israeli LP, Vintage. We have an Asian LP, Temasek. But I still think that the sort of the surround sound outside of entrepreneurs, which are obviously the raw materials for any ecosystem, which are strong and getting stronger in Europe. Investors, I think, are getting better in Europe, but the surround sound is still very, very underdeveloped.
But isn't the surround sound global?
Which is great. We welcome the US guys here, but
it's admittedly harder for international firms without presence on the ground to do seed and Series A deals, because so much of that is early team building. It's referential, back checking. It's getting the first early customers. That is harder to do. It's very unusual for us to do a true seed deal without a close partner on the ground, as an example, in a geography where we don't have an office. And so there is a combination. On expansion stage deals, once there's success, capital is raining from the heavens.
Absolutely.
So, but one of the, there's one other thing I wanted to just challenge Saul on that. We used to talk a lot about there was no exits in Europe because the AIM market was crummy and blah, 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 blah. But now the stock exchanges compete with each other. So you took Criteo public in the U.S., right? Why? That's where the money is.
That's where the money is.
Yeah,
They
and
really
try to find
wanted
an
to list
analyst in
Paris
the
and couldn't.
try to find an analyst in Europe who would understand ad tech. Try to find an institutional investor base. Try to find equity.
Wait, who
analysts.
wants to invest in ad tech is what I want to know.
Well, we will
because
all very
because
happy
I have
to
a
be-
company I'd like to sell him.
It shows two wrongs make a right. Ad tech in France creates a multi-billion-dollar company, Felda.
That's right. That's I forgot. Criteo is ad tech. It's really a remarkable
Yeah.
play. It's a really remarkable. Well, why did that work?
Great entrepreneurs, through and through. It's the single ingredient. They'll run through walls. I'll tell you, one of the real issues remains regulatory bottlenecks. France first and foremost. It is very tough to do deals in France. We are not eager to do deals in France. If there are great entrepreneurs, we'll go wherever in the world they are, and we'll build in friction into the process as needed. We'll absorb friction in the process as needed if the opportunity justifies it. It did in this case.
So it gets back to the entrepreneurs. This is the one place. It's not the one place. This is proof that academic research actually is valid because.
Thanks, Phil. That's the first time I've heard you say that.
No, it really is. I mean, that's what you found was the one key ingredient was the entrepreneur. So let's talk about that, and about the creation of serial entrepreneurs in Europe. How's that going? Are we at a critical mass? Yeah, I mean, you're critical mass. Where are we at a critical mass? Are we at a critical mass in London? Are we at a critical mass in Berlin? Are we at a critical mass in Stockholm? Are we at a critical mass in Dublin?
I think London.
Brussels.
London is clearly, I would say it's sort of Sandhill Road for Europe, or the West, the Bay Area.
Does anybody want to challenge that?
There's no question. I mean,
Generous statement, I would have to say.
Well, I mean, if you just look at the numbers, it is far ahead of any other European center in terms of exits, sophisticated capital, depth of ecosystem, et cetera, et cetera, et cetera. Berlin is probably sort of getting towards it. Rocket and Zalando have been real successes. There are definitely some really interesting emerging companies there, like SoundCloud and others. Stockholm has some amazing companies, Spotify, Klarna, etc. There are pockets of really great companies in most European capitals, Amsterdam, Barcelona, etc., Paris, obviously. But I think, the deepest concentration is absolutely, unquestionably in London. And I think the network effect is only going to reinforce that. However, it is still, and I find it like it's almost like a pointless debate. It is generations behind the Bay Area, and is likely to remain so. So I actually think, the opportunity for investors or entrepreneurs in London, a market that U.S. entrepreneurs maybe don't understand as well, or maybe don't want to address at this point in time. And I mean, it's a contrarian view, but I think if you look at where the real white space is and where the real growth is, Africa is a very, very significant growth area. Most people, other than Rocket, Naspers, who happen to be some of the smartest investors on the planet, I think they still own a third of Tencent. Chinovik, who were pretty smart in terms of their investment in Rocket. Rocket themselves are all very actively looking at the sort of the 10, 15-year view of Africa. I think, Mike Moritz said recently it took 14 years to grow China into a business that really is meaningful to Sequoia. So where are people investing now where they see and believe opportunity in 15 to 20 years' time?
So we're going to do the African one next year.
Welcome you in Cape Town.
I've made a lot of money in Africa, just for the record.
Good. So you know what I'm talking
I
about.
know. I want to know the difference between the European entrepreneur and the U.S. entrepreneur. Is there a difference?
Ask Andy Grove. He's a European entrepreneur.
By the way, if you have questions, pass. Oh, okay, go ahead. Out loud, really loud.
I'm Heider Hida from Bain & Company, but imagine I was Santa Claus for a second.
All right? You're going to get a microphone. This is Santa Claus from Bain & Company.
Yeah, exactly.
This could get really interesting.
Yeah, so imagine I gave each of you $1 billion to spend, but you had to fulfill two conditions.
He has $1 billion.
Yeah, I
We
know,
have $4
another
billion.
billion.
We're really
Sorry.
trying to spend it, I
So
swear.
Santa Claus or Rothschild, that could be too. No, imagine I gave each of you $1 billion to spend, but you had to fulfill two conditions before you could spend it. The first one is you had to show me that the sector you're investing in is more promising in Europe than in the US. Whether it's because of top line or bottom line potential, but it needs to be more promising in Europe than in the US. Which sectors would you invest in? And then secondly, for these sectors, why would you invest in on venture capital scale in that sector rather than on private equity scale in that sector? If you answer those two, you get the $1 billion. Otherwise, you need to pass it on to the next person.
Okay,
Thanks.
boys, this is your chance. Who wants to take it first? Magnus, you want to take a shot at that? Because you actually do have $1 billion to make this consideration.
So I'm afraid, as I said, we are heavily US weighted in this part of the market we're talking about today.
But what would you pick? What would pull you into Europe?
I think where Saul started earlier, it sounds like I agree with Nick in the last election here, but that B2C in Europe, I think, has been very strong, and that we have a strong ecosystem here. And I was looking at the statistics. I don't have research access, but I do to VCs in this sector, and there are 17 unicorns in the London, and of those there were 8 additions in the last year, and the majority of those are in B2C internet, and that's where I would say there's a strong concentration of expertise and finance and ability to scale.
And the second question on PE versus VC in Europe. That was your question, right? I mean, the PE in Europe's actually been quite strong.
PE is a good developed. I mean, our Hermes, and I can see a Hermes colleague here. Our Hermes weighting was sort of 40, 35, 25 US, Europe, Asia. I mean, we were comfortable as a very well developed market. There's that ability to invest with managers through cycles there, and strong track record.
Saul, what's your sectors that you're claiming were stronger in Europe than in US?
I mean, I just think Europe is in so much fundamental trouble that, you know,
wait a minute.
And he's your half full guy, by the way.
If you look at European public sector, if you look at European governments, if you look at large European companies, I think the opportunity, more importantly, the need for innovation in Europe is so profound that you can make money across the board in Europe, because every sector and every country is in desperate need of innovation. So I think if you're on the startup side, whether you're investing in venture, if you're investing in PE, everything pretty much in the next 25 years needs to change in Europe. There's an amazing talent pool, incredible universities in every country, not just in the UK. And, you know, I don't think I would necessarily pick a sector, or, you know, I'm absolutely no expert on PE, but I think if you look at, you know, traditional European companies that need to be restructured, I mean, the opportunities are just endless in Europe in a way that they maybe just aren't in some of the other more developed markets.
Good save, by the way. Turn that around. It's so screwed up, everything's going to work. I like it. Mobile, I think that Europe has an unfair advantage in many ways in mobile that I'd love to see leveraged. Interestingly, as we look in the hard sciences, I do think that potentially space tech out of Europe could have a renaissance here. And then on a relative basis, we do think SaaS is finally coming to Europe in a meaningful way. The U.S. is a larger market, so I think in an absolute sense more great companies are going to be created in the U.S., but I think that the growth rate and the absolute number will become quite meaningful here.
This is not Santa Claus. Go ahead.
Yeah, no. A simple question. Oswald, Tech City Coffee. We know, as Saul said, Europe is in a bit of a mess. I'm just wondering whether, and it's already happening, whether China, India, and Israel could take over from Europe, considering 2 points. One is the funding, the money they have, and 2 is the size of the market. Can you address those 2 points, yeah?
Wait a minute, I'm not, before you take it away. So your question is there enough money to fund the opportunity in Europe?
Or relative opportunity. Interesting. So if you look globally across China, India, Israel, sort of where does Europe rank? Interesting. So, there was a panel of the at an NVCA event last year where it was the legends of venture or something of that sort, and they went down the line and asked all 5 of them that exact question: where in the world, if you were starting a fund today, culture and background agnostic, where would it be? 5 for 5 said China. And so relative even to the U.S. market. And so based on that group wisdom, I think you and population size, GDP growth, et cetera, assume that China's potentially in a bucket on their own. We look at India internally at Bessemer as rivaling China in terms of opportunity. And certainly when you look at their population that's coming online, the growth of per capita income, et cetera, we absolutely think that the Indian opportunity can be comparable. We believe, though Israel's been extremely successful for us, that it is quantity constrained in a very material way. And so we have a small presence in India. It's been a great performing part of the Bessemer portfolio, and probably if you isolated them, it's probably the single best performing fund in Israel in terms of an investing entity, but we don't think the quantity there is anywhere near what Europe can produce. And so if you force me to stack rank, I'd slide Europe right now in between India and Israel.
You're agreeing with that, Magnus?
And our strongest performing fund last year was a Chinese. It was actually a whole life cycle, but venture through to public markets and hedge funds. And if you can find the right manager relationships, then it's a wonderful, wonderful market. I think India has that same potential, but harder again to find strong relationships.
Abstracting, what you're really hearing here is that it all starts with, besides the entrepreneurs, it starts with markets. Markets are really important. Scale of the market is really, really important. But one of the, I've got 2 more questions, but this is a bit of a follow-up to the Santa Claus question. Is geography that important anymore? I mean, when you start a SaaS company, it doesn't make any difference where your servers are.
I think the key point's the one Byron made before about what stage you're investing at. I think if you're investing at seed and Series A, geography, at least as an investor, is really important.
Because of the people.
This is a contact sport. It's high touch. Companies need enormous amounts of support and nurturing. I think after an A, geography becomes less important. But I think that's what's happening within the venture landscape. Is maybe there are 10 funds plus or minus that are actually capable. Bessemer being one, Index is another, Sequoia is another, that genuinely have, a partnership that can span across geographies and operate at different stages. But I think if you're doing seed, if you're doing early stage, you have to be very, very focused on a particular geography. I think it's very hard, particularly in Europe, to cover several geographies if you're operating at seed and Series A.
Yeah, and I'd just add to that certainly geography isn't an excuse and the world is flat. So the beautiful thing is that you can support global markets from just about anywhere. And, Felda wasn't joking when he said he's had a lot of success in Africa. Celtel was one of the biggest outcomes for Bessemer, Sub-Saharan Africa. And, we invested in Skype in Estonia and Criteo in Paris. I've been on boards in Toronto, in Salt Lake City, in Seattle, in LA, in Boulder, obviously Paris. Across about half my deals are in the Bay Area, and I love it when they are. But Felda was one of my mentors in this game early, which is why I'm here, by the way. And he basically said, get your butt on planes. Go wherever the world the best entrepreneurs are. And the reverse is true from an entrepreneur's perspective, which is find your customers. Zendesk was serving a global market out of the gate. They made the decision to move to the U.S. But you certainly could argue that they didn't need to, or at least they didn't need to in the scale that they did, because they were already servicing a global customer base. When we invested in Pipedrive in Estonia, they had a hybrid management team, but they had already sold into a large number of U.S. and international customers. That's the way of the world now, and it's a beautiful empowerment from the internet, whether you're an online consumer or enterprise business, and so use it to your advantage.
I think we're sort of answering a question that we always get. I love this question, by the way, which is, how does an ecosystem start, with the entrepreneurs or with the VCs or in some other way? And the answer is with the entrepreneurs. I mean, you just heard that, right? To put a venture capitalist somewhere, just anywhere, is useless. Is that, do we all agree? We are in agreement on that. I have a friend who always says there's nothing more useless than a venture capitalist without a check, and that's what without a checkbook. There is. I love this. We were going to get this question anyway. Okay, would you go for an inexperienced entrepreneur with a great idea? He happens to have a PowerPoint with him. But
yeah,
no,
exactly. That's true.
But that's a reasonable question. That's the question we get more and more and more, which is, do you have to have pull? Do you have to be introduced in? Do you have to? And that's part of this whole ecosystem thing about Europe.
But this is where, I mean, I know I'd love to see the data that you presented before extracting out the really mega outcomes, because I think if you look at the mega outcomes, like Google, like Facebook, like Apple, these are first-time entrepreneurs. They're not serial. Microsoft, Cisco. I mean, most of the, whatever the term is for 100 billion or more, most of those are not, built by serial.
Thunder dinosaur.
Think of one. So Michael Dell. I mean, all of these guys were first-time entrepreneurs. So I think you can do incredibly well backing a first-time entrepreneur. Your job as an investor is slightly different, but I mean, I think if you look at the really, really big outcomes, they're actually by first-timers.
Yeah, I love that you said that, and that was the part of Ulf, your data that surprised me as well, and I'm sure it's statistically true, but I'll tell you, there's a lot of discussions that happen around firms and different partnership tables, which is, should we be focused on repeat entrepreneurs at all? Because there is this question of, once people have had success, they get lazy, they've made money, it's too comfortable, it's too easy. The drive and the hunger that comes from being that first-time founder with the vision is hard to replace. And I'll tell you, it's also oftentimes why we are so founder-focused, because you can't bring in that energy or that vision from a hired gun. It's just really hard to do that transfusion downstream, and on occasion we do it when needed. Usually it's, by the way, at the request of the founder who's saying, I'm in over my head and here's what we need to do. But we absolutely love backing first-time entrepreneurs, with one caveat, which is, you said, if they can't get to you networked in or otherwise. I'll tell you, we do very few cold deals, in that we do a lot of first-time entrepreneurs, but they've got to be able to find their way to us through a referred source, or they've got to be able to find their way into the industry in a relevant way. And I'll tell you that the entrepreneurs that we want to back run through walls. They get connections, they get advisors, they get mentors, they get early customers, they get partners, they get great employees. They do just these Herculean things that you sit there and say, how does this, this woman who's 21, just out of school, pull this ecosystem around her? It's because she's awesome and she's going to go conquer the world. And those are the people.
Have you ever had someone show up at the airport and get on a plane with you?
No, that might be a little freaky.
That's happened twice to me. They knew I was going. There were shuttles from Boston to New York. They knew I was going down there. They bought a ticket.
Did you invest in either?
No, but one of them.
Is the restraining order still active?
No, but I listened to both of them. And one of them, I did refer to somebody who did invest in them. It wasn't. We were roadmap investors.
Maybe I should say that. So one thing we did see, though, was that Europe was worse at picking up the good first-time entrepreneurs than the U.S.
This is cool.
I don't know if you guys have any.
Probably
If that
because
reflects
people
any of your
risk averse.
experience.
I think, it's historically European investors have been more risk averse, and the assumption would have been that, either you want someone who's a serial entrepreneur, I think that was the received wisdom, or, maybe you'll back a young founder, but you're going to replace them with a seasoned CEO sooner or later. And I think
amongst the first-time entrepreneurs that Europe financed, they did worse than on the U.S. first-time entrepreneurs.
As the Telegraph article said, there are a lot of bad investors.
We hear this a lot too. Around 3% of European startups that raise seed go on to raise Series A. What can be done?
3%?
That's what this is a claim. It is true. Let's just stipulate the data for a minute. I think the overall point is right. Why, you're wondering, is it that high? How many Seed Camp guys got Series A? How many Seed Camp teams got Series A?
I don't know the Series A data, but I know the key metric that we look at is follow-on. I mean, obviously, at the accelerator stage, you're looking for what they now call pre-seed or seed, and it's about 87%, which is pretty good.
Unbelievable, actually.
But I think
no, I really mean unbelievable.
No, it's just you'll see the data is the same at YC, and that's because of the network effect that you create within the ecosystem.
Yeah, YC it's probably that high.
Yeah, and arguably too high. But what's interesting is you do get a lot of teams that pivot off of starter ideas downstream.
But this is getting to really a serious thing. A lag to this appears to be a gap in Series B funding in Europe. How can we get around this? So, and I think one time or another, I think I might have even talked with Magnus, I know I talked with you once about Series B. Is there real gaps in the funding here that has to be filled in? Or do we have not enough of the, quote, right kind of venture capitalists, right? We have seed people and some early stage people, and you can get, as Byron pointed out, you can get later stage money from all over. It rains from heaven once you hit. But there is this gap. Is that a gap still in Europe? Is that part of the problem here?
I don't think so. I think you've got a broader range of investors now as you've ever had, of US VCs who will come and invest in Europe. You've got what used to be called pre-IPO investors, but atypical institutions who will come into those kind of rounds. You've got private equity buyout groups or TPGs of this world who will come in and invest in companies earlier than they were before. And you've got the public markets. And so I would challenge there being a funding gap at that stage.
That's a generous Series B, though, to be fair. If TPG is going to do it, or if T. Rowe or Wellington will do it. It's an interesting point of debate, and I don't have the European perspective as much, but I'll tell you it's been a point of a lot of discussion in the U.S. even. The seed squeeze is what, there's discussion, and this idea that there are so many wealthy angels and even angels list and platforms coming out and the super seeds and the accelerators and things that it was creating a glut of companies that the venture market couldn't digest. And so what would happen? How would this play out? And capital markets are efficient, they adjust. And so you see this, if one gets ahead of the other, pricing adjusts a little bit, it works through. But from our standpoint, more great companies being founded is only a good thing. And that ultimately, if you find that there is this shortage, then more international firms are going to come in to try to fund the gap. I'll also tell you, European companies are much more capital efficient, which is why you see new debt firms like Columbia Lake coming into the market, because debt can actually bridge that in a fairly meaningful way also, because these businesses oftentimes don't need the capital that, heavy CapEx, Silicon Valley type businesses require from day one.
I think just to sort of add to that point, one of the things I've seen the most, I remember doing the first startup I was involved in Boston in '95. We raised a $3 million Series A. We probably spent $1 million of that on our Silicon Graphics Indigo server that sat in a closet, keeping our website up. But
the equivalent of what you can now buy today for $1.92.
Exactly.
Right.
Or on Amazon. Or
yes. Yeah, right.
But, one of the things that's happened is the average Series A, I think, in the U.S. is now 10 million, and in Europe is 8 million. There is this massive gap between what people perceive seed to be and what Series A actually is. And to me, that is just this yawning gap. So, there is the notion, obviously, that, with open source, with cloud, with accelerators, there are more startups than there ever have been before. But actually, the size of a Series A is 3x what it was 10, 15 years ago. So there are a lot of people being left in the desert.
But that's just title inflation, isn't it? Because you use the term pre-seed. So now the accelerator gets them started. There's a pre-seed round. There's a seed round. There's a Series A, and so it feels like everything's just place shifted to.
But then should we then retire Series A and call it seed?
Or call it Series C like it is?
Yeah. I think this is confusing to entrepreneurs, because you've got a lot of people writing what today is a Series A check, which 10 years ago would have been a B or a C.
By the way, this gets to a sort of a it's when China started to put in broadband, they didn't have copper in the ground, so they could go straight to fiber and fast wireless, and you could. There is that same analogy here in Europe. In the U.S., venture capital was a very small, Series A, B, and C, and at one end was friends and family, and at the other end were IPO and trade sale. Now there's whole ecosystems at the other side, and this actually may be a bit of an advantage to the wave of indigenous VC firms like Saul's that are starting, in that they're starting right now already knowing that these things exist, whereas we've all had to adjust to that. We've had meeting after meeting about what do we do about the angels, what do we do about the private IPOs, and all that sort of thing. So Europe has grown up in a new world. There's a lot of regulatory questions, but here's my favorite one. Brexit, bothered? ? And by the way, the second question on this is, can I call you guys in 6 months? I'm working on a B2C product doing market validation in May. You've already gotten the formula about that, right? You just run through walls. The answer is anybody will talk to you if you come through the wall rather than the door. I'll exclude you from this. What do you think? What would Brexit do to the venture environment in the UK?
Well, I don't think it'd be a great thing for UK PLC, but I don't think it's going to happen. So we're not.
And that's your answer, right? I'll just tell you something. It will totally, completely, 100% kill whatever is started in the UK, and Berlin will instantly become the center of innovation, which I think Berlin may already be the center of innovation, but we can argue about that later. Cost level of doing anything in Berlin is about a third, right?
Portugal's 20%.
There's a certain latitude you just can't get below to make money. It's a rule. It's a rule I heard somewhere. I'm saving one last question there. We did actually have a question on venture debt, which I want to broaden to the environment in Europe. Is Europe missing anything now in the environment? Lawyers. I mean, venture debt is, you don't use venture debt here as much as we do in the U.S., but in the U.S., by the way, in the Bessemer portfolio, 62% of all U.S.-based companies have venture debt. That's a stunning number. When I calculated that number, my partners were stunned. I asked them, how much do we use venture debt? They said a third of the time. What's twice that? But there is a new ecosystem here that doesn't have to do with the venture people or the entrepreneurs, but the things that support them. Is that mature yet?
I think it's getting there. I mean, certainly there are, the lawyers, venture debt providers. As Ulf said, I think, the people that are still, I think, behind the curve in the UK and in Europe in general. And I do think this is one of the major advantages of still being a SaaS or an enterprise company in the Valley, and it's one of the reasons, Zendesk moved from Copenhagen. I mean, we saw and missed it at Seed and Series A. I think CRV did the Series A, and you are likely to. It's very hard to get big corporates to write you a check as a Seed or a Series A company, whereas in the Valley, there are probably 30 to 50 companies within a 10-minute drive who are early adopters of tech. Some of them are big tech companies like Cisco and HP and Google and Facebook. But here it's still very, very challenging to get a big company to buy anything from you if you're a startup, or even test something from you if you're a startup. Yeah. So I think that part of the ecosystem is still way behind the curve, which is why it's still challenging to be an enterprise company outside of the Valley.
It's a fair point. I would note, though, that very seldom do our companies actually drive to those companies to sell them anything. And the modern sales rhythm, particularly for mid-market SaaS entry points, is entirely web-based, WebEx and webinar-based sales processes, very low friction. They don't know where the heck you are. You could be sitting a mile from them in a Cuban Mountain View, or you could be sitting in Berlin or London or Estonia or wherever. And we see that to a shocking degree, so much so that hiring right now is brutal in SF down to San Jose. And our companies, it's the grass is always greener. The discussions we're having there is where are you going to open your next office, because we can't scale in SF anymore. And where are you going to open your third or fourth presence, and how are you going to enter Europe, and how you can do these things. Because there are trade-offs with everything. And I'll tell you, use your advantages. You've got access to labor, you've got lower cost structures, and you've got access basically to the same markets. Maybe you drop a few biz dev bodies in these few regions, you do some direct marketing, online marketing with direct targeting to them, but the disadvantages are much smaller than they used to be. And my answer to the question is going to be grab mentors and seed capital around it, because I think they will guide you there as well.
I'm sorry I'm not getting to all your questions. I'm trying to summarize, and we are about out of time. And I've saved this question for last because I know where it came from, and I know, at least I have a guess out of 1 out of 65 people it came from. What advice would you give current students who want to break into venture capital? And by the way, that's a serious question. That's a hard problem, and all three of you have done that. So what's your advice? If somebody here, first of all, let me just tell you, if you're really any good at something, go and start a company. That's where we need you. Now, if you turn out to be less than good and want to be a venture capitalist, how would you advise somebody? I'd love to hear this answer from all three of you.
I would just encourage you to go to VC firms, go and pitch them, go and turn up, go and do some work experience. And there's no systematic career path for working in venture. You've got to go and do an MBA, you've got to go and do 4 years in investment bank, you've got to do X in management consulting. There's a lot of it is chemistry in those small organizations, and go in, work, and impress people.
Yeah, I mean, I would say the same thing, but I also feel there is no better experience to helping support entrepreneurs than having been one yourself. I mean, I absolutely never thought I would be an investor. but it was only really as an entrepreneur understanding what investors did that gave me an appreciation for that, and then encouraged me to sort of sit on the other side. But I'd say, you know, being an entrepreneur, being part of a startup team, even if you're not a founder, being part of the first 5 or 10 people in a company is incredibly valuable experience. So the more exposure you can get to the board and to the investors, you know, the better as well.
Yeah, just to add to that, I'd say get as close to it as you can, and ideally with people that you respect and aspire to be part of, in the sense that whether it's an existing top-tier firm, an up-and-coming collection of partners, you know, a new group, what have you, get as close to it as you can. Some firms take interns, we don't. Some firms hire junior professionals, we do, but there's a limited number of slots. But the next thing we do is often source from our portfolio companies. And so if we see a great person that we don't have a slot for, we'll refer them out to our portfolio companies. And if you are a star in that setting, or even better, a founder, as Felda said, you'll control your own destiny. And if venture firms won't hire you at the back end of that, then start your own damn fund, because you're going to have enough money to do it. You can be like Magnus and be an LP with us. You know, just getting around that ecosystem. I went through it both ways. I started as the most junior professional at TA Associates, cold calling. Took the only job they'd offer, got exposure to the industry for a couple of years, and then went out and started a business because I wanted to get that experience, both as an entrepreneur, but also to understand sort of both sides of the equation. And that and Bessemer was my largest shareholder and investor, so there was a 5-year two-way job interview that happened in that process. And that certainly made it easier to come back as a partner to the venture industry. And so there's no right answer, but the more visible you are to people that you want to work with, the more likely you are to have all sorts of options.
And I've said this for 30 years. You do not have to be an operating person to be a good venture capitalist. I could not run a delicatessen. And
it's often a disadvantage.
Yeah, and it can be a disadvantage, right. And everything I use in my day job, I learned in the last 2 years. So it's the way it works. We are out of time. What I would say, there's 2 things that I would take out of this. One is that the data says that we're at an inflection point, and that we may be going ahead in Europe. Europe may finally be here as a viable, not viable, but as a strong venture ecosystem. And the second thing I hear is, if you had a choice of going to Silicon Valley and doing venture capital, or going to Berlin or London and doing venture capital, you would take the latter, because there's much, much more headroom here. And the third thing that I might just add is the policymakers ought to be thinking about this. I mean, they ought to seriously be thinking about this in Europe because of the statistics that I cited earlier. I want to thank the panel, Ulf and Magnus, Saul, and Byron. For these guys to take their time to do this is a real public service. And I think there was real information here. I want to thank you for coming to the LSE. The LSE is a really important place. It was started in 1898 trying to make the world a better place. So I always say it was started by the Fabians, George Bernard Shaw, and Sidney and Beatrice Webb, and it sort of never got over that. And but it's one of the I have a real point of comparison between this school and a school that has 250 times the endowment. And this place, because it has gatherings like this that actually have an effect, because most of the people in this audience are actually going to go out and do something about the topic, is really, really powerful. So I want to put that plug in for the LSE. Keep your eyes on this school. We're trying to move ahead in this area of venture capital and private equity. Thank you for coming. Thank you all for being here.